Trying again. Welcome, friends, to our weekly High Rock video. I am Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. And we're going to chat about what we see happening in the global economy and financial markets and the world of wealth management and how we are adjusting our investing strategy accordingly. If you are watching for the first time and are interested in learning more about High Rock, please check out our website at www.highrock.ca.
Good catch.
As you know, we have three models that we utilize to create our portfolio strategy. Paul, what have we been up to lately?
Well, we haven't had a video call in a couple of weeks, so I'll just rehash a little bit for folks. The market was the overall U.S. stock market, that is, and the bond market, government bond market in the U.S., was very, very nervous the first week of February. And as most people know, U.S. stocks dropped about 10% or so. And we were very fortunate and had good foresight to do a bit of buying darn near the lows on February 9th. And the market was getting hit down. And then it quickly rebounded up again within another week by about 8%. We did a very small amount of profit taking, and that's all in the global equity model. Fixed income equity model, there were no changes. And tactical, we are in the middle of trying to do a trade where we are going to, we've been buying, but unfortunately it's somewhat illiquid, but we're buying a preferred share of a company most of us already own this preferred share. We're trying to buy more because the valuation on this pref is quite cheap, very cheap, as cheap as we've ever seen it. Unfortunately, these are just retail amounts at trade, and we need to buy a decent sized position. And for that, it's a switch trade. We'd be buying that and selling the bond of the same company, the same issuer. So we're in the midst of trying to do that trade, and I think it would be a great one if we can actually get it done. But that's it for changes, Scott, in the models.
Sure, and you're talking about the markets and relatively speaking, with regards to the S&P 500, and then a series of six stocks, Amazon, Apple, Facebook, Netflix, Microsoft, and Google, that all seem to have a significant weight right now in that S&P 500. And any comment on what you think this might mean?
Yeah, I mean, they've obviously done extremely well when you look at these so-called FANG stocks. And as our viewers will see at the far left part of the page, all the FANG stocks and the S&P, which is in white, all start the year a year ago at 100. They're normalized at 100. So if you look up the right-hand side, you'll see what they are at today, and you can derive a percentage increase. Just an enormous part of the market. And Scott, we could probably even look into it, but you had some stats maybe a year ago or more that actually showed what percentage of the overall market these stocks were. That would be interesting to look at, or even what percentage of the market being up, what percentage was due to these so-called FANG stocks. But they've been extremely impactful, and it's a handful of stocks.
Yeah, and a lot of volatility as a result. I mean, you mentioned we were doing some buying back in February the 9th or 10th when markets were pretty much hitting their lows, and that created a whole bunch of value in the S&P 500. And we were taking advantage of that, which is something that obviously we want to be able to do. We pretty much got back close to the 5-year average price earnings ratio, which isn't full on value over a longer period of time. As you can see, we'd much prefer to be buying things well below the 10-year average, but we bought a little bit, and then, as you said, things as they pop back up, that value got almost taken right out of the market. So I think, in essence, to do a bit of profit taking after an 8% gain in basically a week and a bit, I think that probably made some sense, right?
Yeah, absolutely. Discipline.
Yeah, and now let's go back here too, because I think this is important when we look at the S&P 500 over a longer period of time and the relative economic growth that's happened before 2008, 2009 financial crisis. There was a much greater correlation between stocks and economic growth in the U.S. And of course, with all of the monetary easing that the Federal Reserve, the U.S. Federal Reserve, has been doing, it added some impetus to stock buyers as people needed to put their money somewhere because there's a lot of liquidity floating around. But
And
U.S.
also,
economic data
because
really hasn't kept up with what's been going on in the stock market, and something's going to give at some point. Do we not believe that?
yeah, and I was going to add, Scott, too. Traditionally, um, traditionally, a lot of money went into government bonds in the past. Well, since the credit crisis, really, that just didn't provide the yield that it used to provide. So a lot of money and leverage, which we've shown that chart before on the margin debt versus the S&P, a lot of that money went into the equity markets, and I think that's sort of the gap or the mouth of the dragon here that we've seen over the past 5 years or so between actual economic growth and what's built into equity markets at this stage. And another thing we could show next week, perhaps, is we've shown it before, maybe a month ago, is the dividend yield on the S&P versus the 2-year yield on the U.S. government bond. That kind of gets interesting when you get up. That 2-year yield now is up around 221. It got up to 227 area. So around that 2.25 mark. I wonder if that drags in a lot of pension money and money that really needs to focus on yield as opposed to equity growth or capital gains. So we should maybe show that. And again, for our viewers, we did buy some tier treasuries about a month ago or so as a placeholder, but also as part of our risk management profile.
And we've got a lot of economic data. That's something that you and I were talking about before. We've got a lot of economic data coming out this week. It usually happens towards the end of the month. But anything in particular that you think might be worth having a look at?
Well, I think we'll probably track that core CPI, or core PCE, the personal consumption expenditure, which is the U.S. Federal Reserve's number one metric for looking at overall inflation. That's something to look at, and we could also continue to look at wholesale inventories to sales as they come out, because that's actually a positive right now. So I think what that chart we're looking at right now, the yellow line dropping down to the bottom right, says that inventories are actually shrinking while sales are going up, or certainly on a ratio basis. So we like to see that ratio continue to move down. That's a positive for the economy and the markets. In fact, there are obviously positives out there. They're not all negative, for sure. And there's one positive.
And let's talk now a little bit about what's been going on with bond yield, the bond yield curves. We did see some significant flattening in the U.S. government bond market between the 2-year and the 30-year bonds, down to close to 80 basis points. It widened back out as inflation data indicated that perhaps we might have to see bond yields move up to create a better premium between bond yields and inflation. That seems to have subsided a little bit over the last week or so, and we've got the yield curve flattening out again. Any comment there?
Yeah, well, I think when you saw that curve starting to move, the 230s curve starting to widen out a little bit, which coincided with the stock markets coming off 10%, I think there was a lot of fear built in that the new chairman of the Federal Reserve in the U.S. was likely to raise rates. And as you said as well, Scott, that there was some inflation data that came out that perhaps spooked the market a little bit. And we're seeing it today, in fact, that bond yields have recovered or rallied to a lower yield, lower rates over the past week or so, and we're seeing the stock market improve. And today is a point in fact that maybe we could even look at correlations because they seem to be, reasonably highly correlated at this stage, which is not really something we always want to see. We'd like to see if stocks do sell off that our government bond portion in our portfolio actually improves to balance out some of that risk.
So right now we've got both bonds and stocks improving at the same time, which is kind of the opposite of what was happening 2 weeks ago when you had both bonds and stocks prices weakening, right? Bond yields going up and stock prices falling precipitously.
Yeah.
Interestingly as well, the Canadian situation is a bit different, right? Because we had some pretty weak employment data at the beginning of the month, and sort of the fallout from that, we've seen a weaker Canadian dollar, and our yield curve did steepen, but certainly not nearly as much as the U.S. curve, right? So we've actually seen the spread between U.S. and Canadian bonds, 10-year bonds, start to widen fairly dramatically over the last little while, from a 40 basis point gap to over 60 basis points.
Yeah, and I think as most of our clients and viewers know, and I was actually just quoted in the paper, although a week ago through a Bloomberg article. It was in the ROB and the Financial Post, but unfortunately I maybe was misquoted on a few levels. But one of the things was like, I don't like Canada, quote unquote, and that's not necessarily true, but it is from a investing point of view. That was pointed out to me by my wife and middle son, that I shouldn't be heard saying I don't like Canada, because I do love Canada, but I don't really like it from an investing point of view right now, and I've written about it in our blogs and a whole bunch of reasons. But I think I think that spread's going to go right back out, probably beyond that 90 basis points where we were back last summer when the bank independently hiked up rates a couple times. So,
and that in essence could really be a weakening Canadian economic situation and a continued flattening of the Canadian yield curve, and not as significantly flattening of the U.S. yield curve, I would imagine, right?
Yeah, I agreed, and probably the currency, as we've seen, as you mentioned, over the past week or two, well, probably just a week. It's starting to weaken off again, and we're positioned long more U.S. dollars at this stage. We've hedged up some of that exposure on the FX side as well,
and that has also been helping our client portfolios over the last week or so. We've seen not only bond yields coming down and bond prices rising, but also the stronger U.S. dollar against the Canadian dollar is helping the client portfolios, because we have a weighting of, depending on the client, somewhere between 15 and 20% of their portfolios right now in U.S. dollars.
Yep.
All right, well, that's great. Paul, thanks for all your input. That's it, everybody, for this week, but we will be back next week. We're experimenting with our format. You may have noticed that. We're wide open to feedback, so if some people don't want to see our ugly faces, other people have said that they like seeing our faces, but please feel free to let us know if you have any input one way or another. But anyway, look forward to seeing you all, or talking to you all next week.
Have a good week.